My name is Andrew Stotz, and I want to welcome you to Careers in Finance, where I talk to people working in finance to understand what they're doing and how they're making the most out of their careers. Why do I show this? Because I had an amazing career in finance. I enjoyed my work. I still enjoy my work. And I want to help people realize that there's so many different types of careers in finance that we can do. Today, I'm excited to bring in a neighbor of mine from Malaysia, and I'm going to bring him in right now. And that is, whoa, hold on, working on my technology here. There we go. Gregory Bournet. Gregory, how are you doing?
I'm doing very well. Thank you, Andrew, for having me here. And I'm looking forward to a chat with you.
Yeah, and I'm looking forward to talking with you. I've already, we've been enjoying a relaxing chat, which is what this is all about. And so, just want to highlight to people who joined. Feel free to write in the comments if you have any questions. And occasionally, I'm going to stop Gregory and just welcome people and other stuff. So I see Amit there. Good to see, and also Oluwafemi from Nigeria, I believe. There's Momin from Egypt, Ashwin from Thailand, and another LinkedIn user, but I can't see the name. So, welcome to everybody. I want to again highlight that feel free to ask any questions as we get through this. I don't think there's a question that you could ask that Gregory couldn't answer. But why don't we start off with what is your job? Maybe you can just describe what you're doing now, and then later we're going to go back step by step and kind of look at how you got to where you are.
Perfect. Thank you. Thank you again for having me, and welcome everyone who is joining our chat today. What I'm doing now, I'm a partner at PricewaterhouseCoopers, and I'm leading the M&A practice, the advisory practice across Malaysia and Vietnam. Essentially, I'm either helping businesses to be sold, connecting to potential buyers, or I'm helping overseas investors to acquire businesses here. We do a little bit of fundraising as well, working with some of the younger companies in the ecosystem of Malaysia. So that's it in a nutshell. Obviously, could go in more details, but in a sense, it's the investment banking side of M&A.
Sometimes when people hear M&A, they think of an investment bank. Why? How is it? What's the difference between an investment bank versus a consulting firm when it comes to M&A?
Very good questions. I get it a lot, and we still struggle a bit as a Big Four to be recognized as M&A advisor, but not to do too big of advertisement. But when it comes to mid-market deals, which defined by Thomson Reuters, everything below 500 million, it is actually the Big Fours and the boutiques who do way more deals. The big deals, the billion-dollar deals, typically is the investment banks. They're front page of Financial Times. You see this. So the only difference is that I don't have a balance sheet to leverage. I do not provide my own financing in a leverage buyout, whereas banks, they would provide financing facilities. But the advisory piece is exactly the same thing. So when it comes to a process, how to run a deal is the same. And in the last few years, I've actually done deals which were $1 billion and had opposite Morgan Stanley, Goldman Sachs, and so on. So I'm not shy to punch above my weight.
Well, it sounds like it's not above your weight in the sense that that's exactly what you guys are good at. And if somebody needs a balance sheet, I'm sure you can find it for them. But also, if somebody needs a balance sheet, they may not go to some, a firm like yours or any other of those. They may say, well, I just want to go for the balance sheet. Maybe you can just describe what is it mainly buyers or is it mainly sellers that are contacting you guys for your firm and yourself?
It is probably now 50-50. It all started with me working and living in Japan, as we briefly discussed before. And Japan historically is a market with FDI going out. So it's an outbound market. And when I was there, 90% of all my deals were with large Japanese corporates, the Keiretsus, the trading houses, to acquire assets overseas. I was constantly on a plane to the US, to Europe, to Southeast Asia. So this knowledge and my connectivity to this investment corridor from Japan and now more and more from Korea has helped me to build that track record here. So I think it's maybe 50-50. So one half is really large corporates to acquire assets in Southeast Asia. And then the other part is either private equity owned businesses who look for an exit, or it's family owned businesses who have succession issues and they come and ask me, Greg, can you help me to sell my business? These are typically a bit smaller deals.
And what is the state of family business these days in Southeast Asia or Malaysia or Vietnam? Is it still there, or are they more listed companies? Or maybe you could talk just a little bit about what's going on in the family business space.
Family business space is still very, very active. And as in many economies, also in developed economies, SMEs, like the small medium enterprise, is actually the majority of what constitutes the GDP. So both in Malaysia and even more so, I think, in Vietnam, family businesses constitute a significant amount and a big portion of the market. Now you have, maybe 10 years back, the size of family businesses in Vietnam was really, really tiny. But with the acceleration of the economy, these guys have grown quite dramatically. And of course, you hear of VinFast listing in New York. And so you hear in the newspapers, it is the bigger companies which are there. But there is, both in Malaysia and Vietnam, a very, very vibrant family-owned business practice. In Malaysia, is mostly the Chinese Malay who have started their businesses, whereas the Malay probably rather in GLCs, government-linked companies, and so on and so forth. But yeah, still very vibrant. And the only reason, or most of the reasons, is that there is a succession issue. There is just no children in the business. And at some point, you have to retire and you hand over your business if it's too small for an IPO, for instance.
A lot of my students in the valuation masterclass boot camp, they want to be M&A, they want to be investment bankers, and sometimes they understand what that is, sometimes they don't. Maybe you could just walk through, let's just imagine a mid-sized family business. It's a reasonable size, it's not small, and they come to you for the idea of, hey, we're looking for someone to buy this company. What are the steps that you go through? I mean, you got to go get to know that family. Maybe you look at their financials and say, well, you got to clean some of this up, or, hey, you're not that profitable. Maybe you should, try to get more profitable, or is it just, okay, take it as it is, and then go out to your network of people and say, hey, I've got this. Tell us a little bit about how it works.
Very good question. And I think a huge difference from my experience in developed markets, right? I used to work in Switzerland, coming to Vietnam and Malaysia, where exactly what you mentioned, cleaning up books and corporate governance issues are becoming more important. But, maybe a bigger topic is, why have I been doing this for 20 years? Because no day looks like the other. And most of the days I go to the office or work from home, and I actually don't know exactly what will happen. It's typically really about troubleshooting and solving issues. But in that case, it's a family business. I first need to get familiar with the sector. I work across many different sectors. It could be FMCG, it could be consumer finance, it could be a fintech company, it could be a school, it could be a hospital. So I need to familiarize myself very quickly with the sector, because the client would expect me to understand some of the typical issues. They would want me to understand the competitors and so on and so forth. I will never know as much as these people who have been there for 20 years, but I need to have credibility to be the first line of defense. So I will get familiar with the sector. Then, rightly pointed out, I will look at their financials. Who is their auditor? How old is the business? Who is on the board? And I will figure out, is it really a very, very family business, or is it to some extent institutionalized? There is maybe some professional investors in there. And then particularly in Vietnam, to some extent on my deals in Thailand as well, or Indonesia, FCPA UK bribery is a big problem. 10 years ago, business practices which were very common, so this is bribery, or people have just accepted. But I think now, particularly in M&A, when you have a European or a Japanese buyer to look at the family businesses, they cannot accept any, I say, hanky-panky, and the scrutiny of compliance with law, compliance with regulation has changed dramatically. Even over the last 7-8 years I have been in Malaysia and Vietnam, I can see investors becoming a bit more difficult. So for me, this is a big part of my business, to understand my client, the level of sophistication. Then we go through the book, and then in simple words, we produce a document summarizing the equity story, why should someone buy this company? It's the organization, the financials, their clients, their business or their products. And then you knock doors globally for investors you feel could have an interest, and then you bring them to the table and you explain the business. You then do evaluation, of course, and you hope that someone likes this business, pays a lot of money, and then my client's happy, I'm happy, and I move on to the next project, right?
And how, just for people who don't know what FCPA is, the Foreign Corrupt Practices Act, which is coming out of the US?
That's from the US, and in the UK or in Europe, it's called FC UK Bribery Act. So FCPA originally was only related to government officials. So let's say you have a family business in Vietnam or in Malaysia, and you need a license for your business to operate, and you invite the government official who gives these licenses, and you help a little bit with the approval. So it's mostly geared to our government official. But the FCPA UK Bribery Act goes beyond government officials. So is anyone, a supplier, a client. The moment there is some facilitation payments, you basically go to jail, and this is illegal practice.
And is it illegal in the local markets, or is it only matter for the US or UK?
Very, very good point as well. The government-related bribery now in Vietnam and Malaysia is now also illegal, so that has been addressed. To businesses, a bit more leeway. So let's say it's Chinese New Year or Tet, you go to your clients and you give a little bit of something back. It's still acceptable, but the problem is the moment you have a US-listed buyer, a Japanese-listed buyer, they have to be compliant based on their own rules. They cannot have a subsidiary anywhere in the world where they don't feel comfortable that ABC is implemented and all the contracts are okay and there's a whistleblower program and so on. So it's a bit more difficult.
It's interesting because in the old days, I remember that this was, all the pressure was put on the buying company and their executives and all that. The idea of kind of reaching through into the countries. And I've heard from others. I had another person I talked to, not on this show, but over the weekend, who is a barrister for many years, and he's involved in this. And it's just amazing how far the hand of the US government is. It makes you realize like they really are the policemen of the world, for good or bad. I don't know, but
They are. And I also can tell you that what was possible 10 years ago with some of the larger US private equity, the TPGs and the KKRs, they would have maybe signed a deal and then said, before we complete and really acquire, you need to cure. There's a few things. You need to train your sales staff. They cannot do this. You need to implement this and this. But nowadays, they wouldn't even touch. They basically say, unless it's a big four to audit your accounts, and unless you have implemented ABC practices and we can see it, we will not touch this deal. So the pendulum now has swung back quite dramatically. And it is very painful to go to a family business, to the owner, and explain, if you want to introduce sophisticated buyers from Europe, from the US, from Japan, then this is what's going to happen. And these people at the beginning, they throw their hand up. And there is also an issue that if you move to compliance, you may lose revenues, right? They may say, if I don't do this, Greg, I will not make any business, and they will all go to my competitor. But the problem is, slowly but surely, you have to move towards a more compliant form, I think, of doing business if you become more sophisticated as an economy.
That's a great discussion. And I think for people who are listening, the importance of compliance and the importance of following the law, but not just, some people will think just operating in Vietnam, Malaysia, Thailand, or whatever, you just follow whatever's here. But when you go out into the big world, there's a lot of different regulations. And of course, that means there's a lot of consultants that you can pay a lot of money to help you become compliant.
That's correct. That's correct. It's also in my interest to address such issues. But Andrew, the issue is when you meet someone who owns such a family business, that's not the first thing I can ask. And it's not the first thing they're going to tell me. Sometimes I'm just this much ahead of the investor because I also uncover as I go along, and I need to manage these situations in a very careful manner, not to upset my client, not to upset the investor, and to ensure that things are being addressed and managed in a cultural way reflecting the environment of my client, and also in a cultural way reflecting the environment of wherever the buyer is from. So I need to be very sensitive.
That's what we call kid gloves, right? When you put on your kid gloves, and then that's the value of your role. Another part of your job that I think is fascinating for people is, how do you value companies? Okay, fine. Now that you found that they're compliant, their financials are pretty good. It's a reasonable sized business. It's not a small one. And the buyer is serious. They're going to pay serious money for this. And they're probably going to extract a lot of value from it because maybe they already have a distribution network. And so they're going to bring this product into that or something like that. How can you give us a rough idea of how the process of valuing a company like that goes?
Okay, very interesting as well. If I'm selling a company, my feedback to the owner of the company is that we don't necessarily need to do evaluation, because there is valuation and there is price. And I can do evaluation, DCF, multiples, transaction all day long. But what is really important is someone willing to buy and someone seeing the same value you see. So typically I say I can provide some benchmark, but then whatever Japanese or US or Thai buyers are willing to pay for you, considering the synergies and the equity story and the uplift, that is the valuation. So for us, it's really just back of the envelope. When you're on the other side, when I'm supporting Korean investors or European investors to acquire business, then obviously you have to run through the motions. And many of these more sophisticated investors, they have also investment committees, and you need to produce kind of a valuation report. And at the early stage, we do very simple multiple-based analysis, right? You look at listed companies which are listed, comparable, similar business model. You look at similar businesses which have been transacted in other M&As. That gives you a range. And then you do a sanity check. And then once you get access to business plan and historical financials, you try to build a model, maybe a 5-year model, and you do a typical DCF, and you try to ensure that the DCF spits out something similar to what you said at the beginning. So we use the very traditional valuation methods. If it's a young company, they have no profits yet, then you need to use other things, APU, revenue multiples, users they have, and so on. So depending on the sector.
So let me summarize some of what you said. You said, I like what you said, there's valuation and then there's price. And valuation is what you calculate. Price is what you receive, I guess. But also the question is someone willing to buy? And, sometimes there's a real hot property and people really want it. And, the other thing you said is, what is the buyer willing to pay? And that also kind of, the message is let them mess around with their valuations and see what they come to you with in some ways. You talked about looking at other transactions that have happened as potential multiples that could guide. And then you said, once you get deeper into it, you may build a model and do some 5-year forecasts. I wonder, one of the questions that, one of the frustrating things for unlisted companies is the discount that they receive. If, the average PE ratio here in the Thai market right now is 17 times. So when a good quality mid-sized company looks at the Thai market, they're not listed, and they say, oh, I want to sell my company for 17 times. Bad news. that's not going to happen. You're going to have a discount. What is the rough, range of that discount these days?
I would say anywhere between 10 and 30% probably. But the trick is if you do a majority deal, that you then say we add 30% back for a control premium, and we try to even this out. So I think it depends on which side I sit, right? You can imagine if I sit on the sell side, I will stress that aspect. If I sit on the buy side, I will stress the other aspect. But I think, yeah, illiquidity premium is probably, or discount is probably 10 to 30%. And then, listed companies also, they have corporate governance, they have quarterly reporting, they have management information systems. They are more sophisticated. And the amount of money you need to invest to put a company on IPO kind of corporate governance and so on is a lot. And family-owned businesses, they just don't do these investments in IT and other things. So you also need to educate them. Someone will need to put these investments in, and they will not pay you for these investments upfront.
Yeah, and that's an argument from a buyer's perspective. Whoa, I'm not going to overpay here because I know I'm going to have to implement all kinds of systems to get you guys up to the level you need to be, from compliance, from operating systems. A lot of mid-sized businesses have stretched themselves, really hard, paying themselves not a huge amount, let's say, but also not implementing some of the more expensive things that they may need to implement. So that's often a case that we see. I sometimes speak on valuation with startups, and I spoke at a place, and there was a bunch of startups in the audience, and they asked me, "What's your advice on getting? How do we increase our exit value?" And I said, "Oh, that's easy, Greg." And they said, "Oh, tell us." And I said, "Double your salary today." And they're like, "What?" But that's going to make us not profitable. And I said, "That's the point. If you're underpaying yourself or you're not paying at market rates, what you think is a profitable business, the buyer is going to see straight through that and say, I'm going to have to go out into the market and replace any of you guys that leave at market prices or even higher. And therefore, what you think is a profitable business may not be nearly as profitable, to me."
Exactly to the point. And this is a huge point of contempt. Every time you have someone, you can argue that for a small business and a buyer says, I need an SAP system, you can resist and say, this doesn't make sense. But I agree with you. If you have management taking very little salary, they will immediately make an adjustment to the bottom line because say it's not sustainable. I need to hire second layer management. And there is other things which, I have found family businesses, they are thinking about selling a business, and a year or 2 years before, when they have a business meeting somewhere overseas, they pay the flight out of their own pocket, not to hit the P&L, because for every dollar they save, they get 17 times more when they sell the business. But a smart buyer will look through. They will look at percentage of expenses and salary and benchmarking, and it is not a smart way of managing the business. So I agree with you to adjust salaries to market levels, to have reasonable expenses for marketing and rental expenses and all these things. It will bite you sooner or later.
I like what Thomas Sowell said. There are no solutions, only trade-offs. Life is like a long balloon. You squeeze it on this end and then it's going to blow up on that. And you think you're being smart, but the fact is you got to look at it holistically. I want to talk about something else that you said. If somebody didn't understand valuation and they didn't understand consulting and negotiating, they may have found it kind of strange because you said, well, it depends on what side of the deal I am on. But what I want to highlight here is that, particularly with CFA, I teach CFA ethics, here at university in Thailand and other places. And the first most critical thing that you have to know, who is your client? And your loyalty is to your client. And your loyalty is not It's not to get a fair price or try to calculate the exact thing. If I could walk into a deal, or you could walk into a deal, and you could get double the price, and it's an expensive transaction, but you could get it, you are
Well done.
representing your client. And I just wonder, what do you think about that? How do you reconcile that?
A good point again. M&A and negotiations, it's not a science. It is an art. And I think, when I progressed through my career, again, I went to university, did a master's, did a PhD, CFA, and these technical skills, including valuation and so on, are the foundation of my career. But the more I spend time, it is more social skills, right? Is reading people, body language, do they smile, they don't smile. And yes, you can do evaluation, but ultimately on many of my deals, it's not necessarily that driving a decision. It's more what you feel in your stomach, other dynamics for you to do a deal. And coming back to the fiduciary duty I have to my clients, because negotiations is an art, and the coin has always two sides.
Mm.
I don't think it's an ethical issue for me to stress either this side when I'm sitting here, or stressing that side, because everyone else will do exactly the same thing. And a good deal is a deal where both sides feel a little bit hurt, right? So that means, they feel, oh, okay, this guy got a good deal, oh, you got a good deal. So I think it's to finding this balance, and it depends on, how attractive is a certain asset, how desperate is a certain buyer. You obviously, when you're selling a business, you can play everyone against each other, right? They don't know how much this guy is paying, and you say, oh, you're interested, but this guy does this. So I think for me, the ethical line is that I will never lie. If I say there is someone else interested, or I have other offers, you can be guaranteed I will not just make things up. But you can play with information you have, and disclosures, and just represent your client in the best way. So
Yeah, what I always say in my valuation masterclass is, valuation is a negotiation.
very much, very
And
much.
I was advising a client of mine, and they were selling their business to Microsoft, and I came on the scene, and I immediately came up with a valuation that was 4 times higher than what Microsoft had proposed, and they were practically screaming on the other end on the Microsoft side. And I said, I've been through the numbers, and this is what I think the potential of this business is. I've run them. My assumptions are not unreasonable, and I can walk through them with you at any point. And, as I said when we hung up, my client was a bit nervous because it's a big number that I did. But I said, I have no sympathy for the other side. I go for the throat. They have 7 to 10 buying employees working on their side to get the best deal that they can possibly get. I'm sorry, I'm not going to give an inch. Now, in the end, we may decide to, give and take. And in the end, we did have to give something. But the point is that, again, going back to, and someone in the comments asked, sorry, what does CFA stand for? So CFA stands for Chartered Financial Analyst, and Greg and I are both CFA charter holders. And basically that means that I would say that it means we have a foundation of knowledge in finance, but it also means that we have a deep understanding of ethics as taught by the CFA Code of Ethics and Standards of Practice. And we're required to follow them. And if we don't follow the Code of Ethics, then we lose our CFA designation. So that's CFA. But I basically look at my job is representing my client, and the other side's job is representing theirs, and let's go.
I agree. There is the situation you just mentioned, it resonates very well. And I need to be careful what I say, because some private equity are my clients as well. But I have been called in situations many, many times where a private equity has spotted a very attractive family business, and they're scared for any advisor to come in, because they know what they're trying to do is to undervalue that business and to get the deal done very quickly. So typically when we come in supporting the sell side or family-owned businesses, valuation goes up by 20, 30, 40%, because we are able to articulate the narrative of an equity story. We know what someone is trying to do and their returns and how they exit. Obviously, sometimes, people are unhappy with, what you had to say and what I potentially have to say. But in the end,
Yep. We've got a good question from one of my graduates from the Valuation Masterclass, Ashwin, who says, I feel like I'm getting confused with your work in M&A, in consulting and private equity. In this context, are they similar or are they completely different, and how?
Well, M&A is just merger and acquisition, and within the M&A, you have private equity who execute M&A as a principal, and you have advisors around M&A who advising either private equity or strategic investors on the process itself. So the thing M&A is the same, but you have different players in the ecosystem of M&A. You have sellers, you have buyers. Private equity can be a buyer, can be a seller. They have their team, and some of the people in their team, they don't need to hire advisors because they're sophisticated investment professionals, particularly when they're acquiring a business. It's not very resourceful. But a private equity, for instance, who would like to sell a business, even if it's a Malaysian business, nowadays, you have to reach out to buyers in Alaska, in New Zealand, and Tokyo, and Korea. And a private equity, they have no resources. Even they have the academic and experience skill set to do this, but it's just a matter of resources. They cannot negotiate 30 NDAs, looking at all the offers, produce summaries. So we're getting in advising private equity on their exits once in a while, but it's the same thing.
Great explanation. And I see one of my ethics students right here. Gibbs says, good afternoon, coach. I always tell them I'm your coach because I'm trying to help them pass the CFA ethics portion of the exam. Let's just take a step back. We're going to be wrapping up in just a bit, but I want to take a step back and think about the beginning of your career, some of the steps that you've taken. And I want you to maybe give some advice for a young person who's, just getting in the world of finance, and they're trying to figure out if it's right for them. Should I be on this side or that side or whatever? But maybe you can just tell us a bit about your progression to get where you are, and then later we'll talk about what's your advice. So maybe just first your progression to get where you've gotten.
Okay, I have actually a little bit of an unconventional start of my career. I did not go to college first, but I did an apprenticeship. So I'm not sure who is familiar, but in Europe, you after the mandatory school, you can do an apprenticeship, which is 3 years for people who do not want to go to university. And I did this with a Swiss bank. It's a relatively good foundation and a stable job, relatively secure. And I did this. And then I had a bit of a remorse, and I had teachers telling me, I think that there is a bit more air in you, and you should maybe try. And then I did it's called in Switzerland the Matura. It's basically the access to university for adults. It was quite tough. So I was already maybe 5 years older than average. And then when I finished this, I got an offer to be a derivatives trader. So I was trading for 1.5 years, electronic trading on derivatives with all the different butterflies and reverse splits and so on. And I didn't feel this was giving me the satisfaction of my job. It made me feel a bit empty, I think. And then I decided to just study. And I studied economics at the University of Zurich, finished with a master's. And then I was very keen to do a PhD with a view to potentially start my own business, and particularly in German-speaking Europe, to have an academic title helps you a little bit in running a business. It just increases trust and so on. And then I went to find a job of someone who would be able to support me with my aspiration to do a PhD next to my work. And I went to Credit Suisse. I went to a few, real investment banks, including Pricewaterhouse at the time, and it was only Pricewaterhouse who was supportive. And I basically worked only 70%, and during the 30% off, I was able to do my PhD courses at the university, and that took maybe 3 years, and I finished off. And then I had my next crisis that I thought, oh, wow. And now for the next 30 years, this is where I live. This is where I work. And I inquired for a secondment. And then they wanted to send me first to London and Frankfurt, I think. And I says, no, I need to go somewhere really out of my comfort zone. And then I got sent to Hong Kong. Then I spent 3 years in Beijing, not speaking Mandarin. So it was really at the edge of my comfort zone, not speaking the language at the time. And Beijing, 20 years ago wasn't very easy for foreigners. And then I got seconded from China to the US to represent US deal flow back to China. Spent 2 years in Chicago, New York. And then I got called to build a cross-border M&A team for Pricewaterhouse in Tokyo. That was another very interesting career opportunity. We had an M&A team, very domestic, as many things in Japan are, no capabilities, to do deals overseas. And with my cultural background, I did this. And then after 4 years, we centralized Southeast Asia under one P&L, and they wanted someone with a bit more experience to kickstart the M&A advisory practice. I was the COO for the whole region for the first 2 years, and now an equity partner looking after Malaysia and Vietnam, heading the M&A practice.
That's a real zigzag, and I think it's a great lesson for young people that don't think too much, do the next right thing, whether that's for you, if it's to go do a master's, or whether it's to do CFA, or whether it's to dig into, what you're doing at your job, but just keep going to the next right step, the next step. And it's amazing where you end up.
I agree. And maybe the key takeaway is, if I compare myself now to my peers who started, at the same age somewhere, what I have done with moving around has decelerated my career for sure. Because the easiest way would be to have a home base, to do a secondment for maybe 2-3 years and come back.
Yep.
What happens if you move? Even I go to the next place and I go there and tell my new boss, I was the best rated manager there. The new boss doesn't care. You have to rebuild your track record and create that level of confidence that you can deliver. So every time I moved from the different places, I had to start again. So my career progression and my promotions was more slower because of that. But would I do this again? Absolutely. From a personal point of view, the experience I have gained working in different countries, different territories is priceless. So for me, I think the advice is, if you purely follow just what is best for your career and you're maybe a bit narrow-minded, you may achieve that goal. But I think for your overall well-being and not to have any regrets of having a missed opportunity, then you should follow the flow and be a bit more flexible. I have many young people, they say, Greg, can you help me to go on a secondment? And then I have an idea and an opportunity. Oh, the salary is this, so the job is not exactly this and not exactly that. If that's your attitude, you will never go anywhere. You win a few points, you lose a few points, but go and make it work and just dive in and thick skin and you will get there.
Yeah, that's great advice. And I know I took an 80% pay cut when I moved to Thailand from Pepsi, where I was a manager, or rising up in Los Angeles, and people thought I was crazy. But I do think it was the best decision. And a lot of people have asked me, as I was an analyst and a successful analyst, they said, just imagine where you would have been if you were in New York. You could have been a leading analyst making a ton of money and all of that. But what I said to them is, well, first of all, you got to remember that you may be making a ton of money, but you may also be spending a ton of money. Remember, it's the gap between your salary and your expenses that matters, not your salary. And so that's the first thing I said to them. But the second thing is that, wait a minute, I'm doing the job I love in the place that I want to be. That's the key.
Nothing
Um,
beats that, right?
yeah. We're going to wrap up in just a second, but I did see a
Sure.
question come in here from Jet Saw. Says, I'd love to get a bit of global exposure. What would be your first step to enter a global cross-border M&A business?
Not easy question, and I
Yeah,
think
that's a tough one.
yes, the difference I have seen over the last 20 years of my career is that it has become increasingly difficult for some more junior roles to get a visa. Even now in Malaysia, I was unable to bring in some people from Switzerland because they said it's not differentiated. This is very different where expats maybe 20 years back, they would always easily be welcome everywhere else. So this means your ability to just move without a job to some new place and just hope to make it work. That scenario is more challenging now than it was 20 years back, I believe. I
Mm,
think the easier way is for you to get a foothold somewhere and then prove yourself and express the desire with an international company to do a secondment and to get deployed with this company. I think that's probably my advice of the least resistance.
yeah. And I would say, Jet, find a great boss, do a great job with your boss, and talk to him about, him or her about what you want. And, it starts with doing a great job. Otherwise, you're not going to get the opportunity. We did have another question coming from Mohammed Iqbal, who says, recently I've completed my CFA. I want to move to Canada or US. Can you guide us? How should we approach for job or traineeship? I will say, in my valuation masterclass boot camp, I had an amazing woman in Nigeria. She worked for a commercial bank as a credit analyst, and she did she was amazing. And the valuation masterclass boot camp is tough, and she survived and graduated while working full time and raising 4 children. And I also teach in the valuation masterclass bootcamp about posting on LinkedIn and sharing your experience and all of that. And so she did that very well. And then after she graduated, about, I don't know, 6 months later, she sent me an email and she says, a firm reached out to her through her LinkedIn and
Wow.
interviewed her and hired her. And now she's living and working in Canada. I was like, okay. So, put yourself out there. LinkedIn is pretty amazing for sure. You've got, if you got your CFA, that's a great start. Also, there's a lot, the Toronto CFA Society in Canada is huge. And so I would try to get involved, see if you could get a membership. They allow people to get memberships who are not CFA charter holders. Sorry, who associates maybe who are not, but also if you are a CFA charter holder, you could join different societies. If you were actually there, little trick that I saw one guy do when I was president of CFA Society Thailand is that he didn't have a CFA and he just started volunteering with CFA Society. And then what happened was he said to me after I worked with him for a while, he goes, "Oh, by the way, next, I'm getting my CFA, next month." And I was like, "I thought you were a CFA charter holder," but no, he wasn't. But he had passed level 3 and he was waiting for his work requirements. But the point is that CFA societies are very in need of help. They are volunteer organizations, and so you can go to a CFA society and say, "Can I help?" If you're already a charter holder, it makes it easier. If you're not yet a charter holder, but you're a candidate, you can still volunteer as this guy did. And then all of a sudden, you're going to be elbow to elbow with some of the top people in your country. It's harder to do if you're not in that country. But the point is, start volunteering, and those people will really appreciate your hard work. That young guy, basically, after he worked with us for a while, he said to me, he said, "Now I want to get on the board." And I was like, wow. But what's one of the requirements for getting on the board? That you've contributed to society. And he was. It was a brilliant move. And next thing you know, he's just one of the youngest guys on the board. And he's been continues to contribute. So those are some of my answers to that one. I think we'll leave that one at that. Um, what is your opinion? Masters of Finance first or CFA first? What do you
For
think?
me,
Yeah,
for you, for
for you.
me. I did the master's first because it was just a continuation of my bachelor's at the University of Switzerland. And what I did the CFA and my PhD at the same time. So my preference was at the time to do the CFA later because the Master of Science here at university is just more institutionalized, and I just went with the flow. But I don't think there is a right or wrong.
Yeah, and I would say in this case too, you have to also ask, are you a quantitative type of person? If you're really a quantitative type of person, you may enjoy a master's in finance, particularly if it's quantitative based. But if you're not that quantitative, like I didn't care that much about quant stuff. I was much more into being an analyst or being a fund manager, picking stocks, understanding the story. It made a lot more sense for me to do CFA than to do the master's in finance. But if you really feel like I really want to become an expert in this area, you know, then the master's of finance can be of value. Okay, I think this is going to be our last question. How is career for fund managers, portfolio managers who are experts in technical analysis? Good question.
I'm not a fund manager and not a portfolio manager. I think, yeah, probably not qualified to answer. Bigger banks or asset management companies probably a better place to start off.
Yeah. And I would say basically after working in, as an analyst serving fund managers for decades, I never met a fund manager that was a technical analyst. That didn't mean that they didn't read charts and really like to see what's going on with price action. But I didn't really meet any that would go and say, okay, I just really look at the technicals. So that would be my answer. Okay. Wow. I appreciate that you've given us this much time to talk, and I know you've got other stuff going on.
It was
Why
fun.
don't we wrap this up by just having you kind of summarize for a young person who's building a career in finance, what would be your, 1, 2, 3 pieces of advice for them?
Never give up. Don't take no as an answer. I had many no's in my career, and I always figured a way out. Not to be directly hostile to my boss, but always to figure a way out to make it work. Be flexible. If you have a plan A and you absolutely have this dream goal, if it's something very close to that, just go for it. Do not wait a year or 2 or 5 or 10 to make a change you have a desire inside. If the change is not 100% there, but it is better than your status quo, just go for it. Think long term. Your career will be 20, 30 years, and the space you're going to work in very likely is small. And I notice now working in finance for 25 years, there is a circle. People will remember you. Even after 5 years, people will move in the same financial circles. Maybe they move from a bank to a client, from a client to a bank, and they will remember you. So always have in mind a long-term perspective, for friendships, for business with clients, with your employees. If someone leaves me, for instance, in my team, I wish them good luck and I want to stay in touch with them, even I'm unhappy they leave. But just think long term, and if something doesn't happen in a year, just stick it out and be patient.
Fantastic advice. We're going to wrap up here, and maybe Greg, you and I will talk for just a minute after this. And then I just want to thank you on behalf of everybody who's listening and, who's looking for answers. I think we've gotten a lot of answers in this. So really appreciate you sparing the time for this today.
Thanks for having me.
Yep. All right. That is Careers in Finance. What a great discussion with Greg Bournet. And I think we went through so many different things about valuation, about M&A deals, about what's the difference between investment banking and advisory, so many things. I just want to say thanks to everybody for joining and all the great questions that we got in. And of course, thanks to Greg for this great discussion. I'll see you in the next Careers in Finance.